This is the AMT tax credit code, and this is the AMT tax credit described visually. When you calculate your taxes, there is a single equation that you calculate to figure out how much of a tax liability that you have. This bar represents that tax liability, and in fact, I'm going to title this RT for regular tax. So this represents your regular tax, and smart people back in the day that were doing tax planning were eliminating or reducing this to very small portions of tax liability. So to kind of stop that practice, the government implemented a second calculation. And I'm going to draw another bar here representing that second calculation that every single person is required to calculate, whether you have complexity or wealth or not. Everybody has to calculate this. And this is called AMT. This is the alternative minimum tax calculation. And so even if you are a smart tax planner that reduces this tax liability, the government has created the second tax liability as a form of them getting their taxes one way or another. So it's really hard to reduce both of these. And the reason why you're probably not necessarily familiar with AMT, even though you're technically required to calculate it, you're most likely going to be having a software do it or a professional do it. They're doing that calculation in the background, but it's not very common that an average Joe triggers it because there's something called an exemption amount to AMT that reduces this. So right off the bat, there is an exemption amount that brings your AMT down. And so if you haven't been familiar with AMT yet, it's probably because of that exemption that you have yet to trigger it. But you're probably watching this video because AMT or the AMT credit is something that is more recent that you are now becoming more and more familiar with. And the reason why AMT is getting triggered is most likely going to be because of incentive stock options. When you exercise incentive stock options, the spread between the exercise price and the fair market value, when you exercise, that spread only gets added to this second calculation. It doesn't actually go into this calculation. Therefore, it brings this number up. So let me show you exactly how this looks when it's the end of the tax year and you're paying taxes. So if you have your regular tax liability and your AMT tax liability, that looks like this. Your tax liability is going to be the exact same height as your regular tax. So that will just carry on over right there. That portion is your regular tax. In this case, you are not paying any AMT. But let me show you how AMT looks when you actually do pay it. So you'll notice in this example that the alternative minimum tax calculation is higher than the regular tax calculation. So when it comes time for you to actually pay taxes, this is what your tax bill is going to look like. You're going to have a portion of AMT. This top portion is AMT and the bottom portion is regular tax. And that's simply calculated by, this AMT portion is simply calculated by seeing how much does AMT exceed the regular tax. Well, it exceeds it by that much, so we're going to tack on the alternative minimum tax onto your already existing regular tax liability. So I like to remind my clients that AMT isn't necessarily or inherently bad if you trigger it. The big and bad scary thing that you want to be aware of is just triggering large portions of alternative minimum tax. So I don't really care if you trigger $1 worth of AMT. It doesn't affect the rest of your tax bill. At the beginning, I explained how AMT was just a way for the government to get their tax dollars or create a tax liability when people were outsmarting the system and reducing or minimizing or eliminating their regular tax bill. So when it comes to the case of incentive stock options, while that's still partially the case, the AMT, when it plays its role in incentive stock options, is actually doing something slightly different. It's actually changing the timing of when you pay your taxes. So if you think about your incentive stock options, when you exercise those, there is no impact to your regular tax situation or your regular tax calculation. You pay zero taxes when you exercise. It's only when you sell that you actually owe taxes. And so the government doesn't want to wait for you to sell in a year from now or in 5 years or in 10 years from now when you actually sell your incentive stock options, they want their tax dollars now. And AMT is a huge source of income for the government, so it's highly unlikely that they will cut this out at any time in the near future. But I want you to think about your incentive stock options with me. When you exercise your incentive stock options, there's only an AMT tax ramification if your AMT exceeds your regular tax liability, correct? So if you're paying taxes when you exercise through AMT and you're paying taxes later when you sell, does that mean that you're getting double taxed on your incentive stock options? And the answer is yes, you are getting taxed twice on that same income. So as a form of removing that double taxation, the government has given us an AMT credit. In the year that you trigger AMT, you are creating the credit. You can't actually use it that same year, but you can use it in subsequent years. And you do so by filing Form 8801, and you need to file that every single year until all of your tax credit is completely recouped. But let's say that you had forgotten to file it like last year or 2 years ago or even 3 years ago. You can file an amendment fixing the mistake of maybe perhaps not even filing your Form 8801, therefore saving you a bunch of money by making sure that you have that tax credit and you didn't forget about it and file your taxes without Form 8801. So now that we have an idea behind AMT and the credit, how do we actually go about getting that credit back? So you'll notice that I changed the height of the AMT, this second calculation right here, to the point where we're not triggering AMT. So that's the first hoop that we have to jump through. There are ultimately 2 hoops that we have to jump through in order to reclaim that credit. But the first hoop is that you can only claim as much credit as there is spread between these 2 numbers. And if you look on your Form 6251 where AMT is calculated, line number 10 is going to be a regular tax number, and line number 9 is going to be your AMT. So if that's a $10,000 spread, then you can claim up to $10,000 worth of that credit back. And it's partially contingent upon the second hoop that I'm going to show you in just a second. But we now need to think about how can we keep this spread as large as possible so we can get a larger credit back. And there's 2 things that come to mind. First, when we exercise incentive stock options and there's a spread or a bargain element, that is going to increase this alternative minimum tax number. And as this number grows, this spread, or in other words, the amount of credit that you're able to get back is slowly shrinking. So if you're trying to get a lot back in a single year, you probably won't want to be exercising incentive stock options, seeing as that's inhibiting your ability to get that credit back. The second thing that comes to mind is there is a tax planning strategy out there called AMT crossover. And while it may make sense in some years, it might also not make sense in other years, like when you're trying to recoup the credit. And what the AMT crossover is talking about is it's saying, hey, because there's all this space when you're exercising your incentive stock options, let's go ahead and only exercise up to this point so that we don't actually trigger the alternative minimum tax, because AMT is only triggered when you exceed this line right here, where it exceeds the regular tax calculation. So if you implement this, you are basically removing or eliminating the opportunity for you to get back any AMT credit. Let me just draw just a quick another little bracket here to represent this is how much credit we can recoup thus far just in the first hoop. That's the first hoop that we have to jump through, but there's actually a second hoop that also limits how much credit that we're able to recoup. And the AMT credit is a non-refundable credit, meaning that it can reduce your tax liability, but there's no refund portion to this credit. Whereas in the tax code, there are other credits that are refundable, meaning they can actually give you cash, whereas a non-refundable credit, such as the AMT credit, this is non-refundable, so it just reduces your tax liability. And I'm actually going to draw just a little circle here to represent tax liability. So regardless of however big this first portion is, the second hoop that we have to jump through is actually squeezing as much of this credit as we can fit into your tax liability here. So that's the second constraint that we have to fit through. So if you have a smaller tax liability, then you can't recoup all of this. You can only recoup as much as will fit through that circle. And this ultimately shows us how much AMT credit we can recoup. Okay, so this little bracket right here just shows us how much AMT we can actually recoup. So no matter how large this first one is, It's really dependent upon the second one. Or you could even flip the scenario and say that there's a small spread here and a big, huge liability over here, but it's still contingent upon that very first small spread. Okay, so I flipped the scenario here, and in this first portion, we're looking at a much smaller spread between the regular tax and the alternative minimum tax, represented by this bracket right here. So a very small spread between these two things. And this time we have a much larger tax liability. But regardless of how big that tax liability is, this big circle right here, it's still limited by how much spread there is between this first portion right there. And it kicks out how much AMT credit we're able to recoup for that year. So now that you understand how the AMT credit works, that begs the question, how do I go about getting the AMT credit back faster? And I need to preface the answer by saying it's not about recouping the AMT back faster, it's all about reducing your overall tax bill. And there's a bunch of little nuances here, so if you want to work with a professional, more information down in the description below. Otherwise, please don't rely solely on this video for tax advice because, again, this is from a very high level. There are so many other considerations such as your filing status or your deductions and all these other things that go into your tax calculation that really change how we tax plan around this. So if you're thinking ahead, you're thinking in order to get the credit back, we can manipulate basically two things. We have control over potentially how much AMT that we trigger or don't trigger by not exercising ISOs. So how can we get a big spread here? And how can we also increase our tax liability? And I'm going to give you just a few examples here. The first one is going to be a Roth conversion. Another example could be NSO exercises. So if you have non-qualified stock options, when you exercise, the spread, which is typically reported under AMT for incentive stock options, non-qualified stock options actually bumps up your regular tax number, and it's considered ordinary income. And lastly, I'll just mention short-term capital gains as another form of creating a larger tax liability and increasing your income, therefore creating a larger chance for you to get your AMT credit back. But before you rush off and make some silly decision just to get back your AMT credit, I need to emphasize one last time that these decisions need to fit into your overall financial strategy. Because if not, and you're optimizing for a tax credit, then you're bound to make silly financial decisions. And focusing on recouping the credit versus reducing taxes is quite literally putting the cart before the horse. But I need to warn you, in several years, the tax laws are set to change. And it really just depends on who's in office. But regardless of who's in office, the tax law is really expiring in the next few years here. So I wanted to inform you on whether it makes more sense to trigger AMT now or later after the tax law change. And so based on the tax law, how it sits currently, it makes more sense to trigger AMT now than it does after the tax law expires and reverts back to old law. That being said, when it comes to recouping your AMT credit, it actually makes sense to recoup your AMT credit after the tax law reverts. I know that may be a little confusing, but I need to emphasize this, that we shouldn't be making decisions solely based on the tax ramifications. That's probably the third most important thing that you should be focusing on. We need to be looking at things such as the financial ramifications of exercising and recouping tax credit and so on. So I've filmed this video right here for you to explain what's more important than recouping your tax credit.